Welcome to Level 4, Lesson 5. My name is RIA the Trader from TradingWing.net. In this lesson, you will learn about company earnings reports, how to read these reports, and how to analyze these reports to understand the company's actual value. Keep in mind, earnings reports analysis are part of fundamental analysis and not technical analysis. So let's get started. Before I begin, let me explain to you what earnings reports are and the purpose behind them. In Level 1 of this course, I mentioned IPOs, or initial public offerings. When a company goes public, they are required to release earnings reports to help provide shareholders with information as to how the company performed on a quarterly basis. These quarterly earnings reports are listed as Q1, Q2, Q3, and Q4. The main idea behind these earnings reports are to allow for transparency between the investor and the company. With regard to earnings reports, there is an order of events. The first event is that there is a press release before the company earnings report. The second event is the release of the earnings report, titled as the 10Q, which is released to the public. If you would ever like to see a company's earnings report, you can simply search the company's name followed by 10Q. And finally, there is an earnings call. This is where the company discusses with analysts their actual 10Q report and allows analysts to ask questions. The analysis of earnings reports are key when it comes to fundamental analysis, as these earnings reports can provide information to both investors and traders as to how the company will perform in the future. When looking at an earnings report, or a 10Q, there are several critical aspects of this report. The earnings per share, known as EPS, the earnings estimate, the price-earnings ratio, or PE ratio, the forward guidance, and finally, the earnings call. So let's go ahead and break down each of these aspects. Earnings per share, better known as EPS, compares a company's quarterly net income by the current outstanding shares. In order to calculate EPS, you would need to divide the quarterly net income by the current outstanding shares. Let's have a look at an example. Let's look at Facebook, now known as Meta Platforms. In the most recent earnings report, Facebook reported a net income of $10.285 billion. The outstanding shares, on the other hand, was 2.81 billion. After completing the calculation, we find that the EPS for the most recent quarter was 3.67. But how do we use the EPS to our benefit? We can use the EPS by comparing it to previous earnings and find if the company is trending upwards when it comes to their earnings or trending down. Just because an EPS is lower in this quarter than the previous quarter does not mean that the company stopped growing. We can look at trends and identify trends to find if the company is growing. Keep in mind, companies do not continuously grow, as they have certain points of consolidation, similarly to stock charts. Before a company's earnings report is released, analysts will attempt to predict the company's earnings in that quarter and provide an estimate EPS based on their analysis. This is known as analyst earnings estimates. They are calculated by taking several points of data to provide an estimate EPS that more so aligns with the current stock price. Once the actual EPS is released, we can use the estimate to determine if the company underperformed, fairly performed, or overperformed. However, just because a company may have underperformed does not mean that the stock price will drop. In fact, companies can release statements as to why they may have missed their earnings or missed the estimate. Following the statement, the market will decide if the reasoning is valid and if there is a cause for concern or not. The third aspect of an earnings report to consider is the price to earnings ratio, better known as the PE ratio. The PE ratio identifies the quote-unquote actual value of a company. It does so by comparing the current share price to the EPS. So in order to calculate the PE ratio, you must divide the current share price by the EPS value. Let's look at Facebook again. The current share price is $323 per share, with an EPS value of 3.67 as we mentioned earlier. This gives us a PE ratio value of 88. But what exactly does that 88 tell us? The PE ratio displays how much dollars you would be paying for a $1 earnings in the company. So in the case of Facebook, you would be paying $88 for a $1 earning in the company. Sounds quite overvalued, right? And that's typically because it is. The higher the PE value, the more overvalued a company is. The PE ratio of 10 to 20 is considered an undervalued company. The PE ratio of 20 to 40 is considered a fairly valued company, and a PE ratio above 40 is considered an overvalued company. This, however, depends on the sector and is not always the case. In tech retail, for example, there is extreme uncertainty, so being overvalued does not mean that the price will drop. In the financial sector, however, because it is overall transparent and has little uncertainty, the PE ratio will typically be extremely low, showing an undervalued number. This does not mean that the price of the financial sector will increase. So in order to accurately use the PE ratio to your advantage, you would need to look at the PE ratio sector by sector. Let's quickly take a look at Facebook or Meta Platform's earnings report. Whenever you open a 10Q document, you should see something that looks like this. The first thing you want to look for is the quarter's net income, and we can see that right over here. This value is not $10,000 in net income, but rather 10,000 million, as the values are displayed in millions. This would equal 10.285 billion, as we mentioned earlier. The next thing you want to look for is the future outlook. Once you scroll, you may see it on the second or third page, and in this case, we see it on the third page. We see that the CFO outlook is that they expect to, in the first quarter of 2022, to have a total revenue between 27 and 29 billion. This is not the net income, but rather the total revenue. Let's quickly go back up and see what the total revenue was for the previous quarter. And we can see that the total revenue was 33.67 billion. Based on this information alone, we can assume that the net income will also be lower in the first quarter of 2022. Obviously, things can change, but this is a great starting point. The final aspects of earnings reports to consider are known as the forward guidance and the earnings call. Forward guidance, better known as guidance, is simply the company's perspective on how they expect to perform in the following quarter. A higher guidance or an increased guidance means that the company expects to perform better than the current quarter. And a lowered guidance means that they expect to perform lower or less than the current quarter. Earnings calls are possibly the most underrated aspect of an earnings report. Earnings calls typically provide additional information not provided on the 10Q earnings report. Because analysts have the ability to ask questions, this gives the company the opportunity to discuss future endeavors and goals, something not mentioned on the 10Q. In addition, individuals have the ability to assess the confidence of company leaders and management. In fact, sometimes management will say things they were not supposed to mention, which can either increase the price of a stock if it is good news, or decrease the price of a stock if it is bad news. And that concludes this lesson.